All right, today we are diving into one of the absolute cornerstones of finance, the weighted average cost of capital, or WACC. Now, I know it sounds a little intimidating, but trust me, it's the key that unlocks the answer to one of the biggest questions in all of business.
So, picture this. A company is on the verge of making a billion-dollar bet. It could be a new factory, a massive acquisition, you name it. How on earth do they know if that move is going to be a stroke of genius or a complete disaster? Well, the tool they use, the single number that guides that huge decision, is their WACC.
So, what is it really? At its heart, WACC is just the blended cost of all the money a company runs on. See, businesses get their cash from two places: shareholders who give them equity and lenders who give them debt. Each one of those comes with a cost. WACC just, well, it averages those two costs together into one really powerful percentage.
And this is why it's so critical. WAC isn't some abstract accounting term. No, it's a financial hurdle. It's the high jump bar that every single investment idea has to clear. If a project is only going to return, say, 10%, but the company's WAC is 12%, that project is actually destroying value. It's not earning enough to pay back the investors for the risk they took. To create real wealth, you've got to beat the WAC, period. Okay, so how do we actually calculate this thing? Let's pop the hood and take a look at the engine evaluation, the WACC formula itself. I know, it looks like a bit of a beast at first, but we're going to break it down piece by piece. And here it is. It's basically two big chunks added together. The first part is all about the cost of equity, weighted by how much equity the company uses. The second part is the cost of debt, weighted by how much debt it's using. Now let's really unpack what each of these letters means. Now here's a super important detail. The values for equity, the E, and debt, the D, they aren't the old numbers you just pull from a balance sheet. Nope, they are based on their current market values. And that's because WACC is a forward-looking tool, right? It has to reflect what the company's capital is worth today. Then you've got the costs. RE is what shareholders demand, and RD is what lenders charge. But it's that last little piece, the tax rate, that holds a really interesting hidden advantage.
Yeah, that tax rate, it leads us to one of the most important concepts in the whole formula. It's what makes debt such a powerful tool for companies. You can honestly think of it as a government-approved discount on borrowing money.
So here's the magic. When a company pays interest on its debt, the government considers that a business expense, and that means it's tax deductible. This lowers the company's total tax bill. So because of this tax shield, the real cost of that debt is actually lower than the sticker price, the interest rate it's paying the bank. Just look at the result here. Let's say a company borrows money at 10%, and they're in a 25% tax bracket. Well, after that tax deduction, the true effective cost of that debt isn't 10%. It's only 7.5%. That is a huge discount, and it's exactly what that 1 minus TC part of the formula is designed to calculate. Okay, so we've built the formula, we get the pieces. Now for the most important part, what does the final number actually tell you? How do you read the signal that WACC is sending?
You know, it's actually pretty simple. A lower WACC is almost always a good sign. It means the market sees the company as less risky, and because of that, it can raise money from both stockholders and lenders more cheaply. A higher WACC, on the other hand, signals the opposite. The market is seeing more risk, and it's demanding a bigger return to compensate for it, which makes capital a lot more expensive.
But, and this is a crucial point for anyone doing this in the real world, the company's overall WACC is just the starting line. It's the hurdle for an average risk project. But what if the new project is way riskier, like, say, expanding into a totally new and volatile market? Well, analysts will add a risk premium to the WACC, creating a higher, customized hurdle rate just for that specific project. And that idea leads us directly to one of the biggest, most common traps in all of corporate finance. Forgetting to adjust the WACC for a project-specific risk, well, that leads to something called the WACC fallacy, and it can be an incredibly expensive mistake. So the WACC fallacy is what happens when a company gets lazy and just applies its one corporate WACC to every single investment decision, no matter how risky or safe. It might seem efficient, but what it really does is systematically distort their judgment, pushing them to invest in all the wrong things. This table just lays the whole trap bare. Let's say the firm's WACC is 9%. Now look at that low-risk project. It's a safe bet. It only needs to make a 6% return to create value.
But when you measure it against that high 9% company-wide hurdle, it looks like a loser, so it gets wrongly rejected. Now, flip to the high-risk project. It's so risky, it really needs to earn 12% to be worthwhile. But that low 9% hurdle makes it look like a fantastic deal, so it gets wrongly accepted. The company ends up turning down safe, profitable ideas and chasing after risky, value-destroying ones. It's a mess.
And believe me, this isn't just a textbook problem. Studies have shown that in real-world mergers and acquisitions, this exact mistake can destroy up to 7% of a deal's value on average. Think about that. On a multi-billion-dollar deal, that's a staggering amount of money just gone because of a simple methodological error.
So what's the fix? Well, for really complex situations, especially when a company's debt level is going to change a lot, think about a leveraged buyout, an LBO, there's a more advanced method called adjusted present value, or APV. It's just a better tool for the job. See, WAC works great when things are stable, but APV is flexible enough to handle those really dynamic situations.
All right, let's switch gears to another real-world headache. How in the world do you calculate WACC for a private company? They don't have a stock price, right? So you can't get a market value of their equity, you can't measure their stock's volatility. It's a huge problem. I mean, look at the gaps. Without a public stock, you're missing the market value of equity, your E. You're also missing its beta, which is the key measure of how volatile a stock is. And to top it off, their debt is usually private, so finding a good market interest rate, ARD, is tough. So what do analysts do? Well, they use this really clever two-step process. First, they find a bunch of similar public companies and grab their average beta. Then they do a calculation to unlever it, which basically means stripping out all the financial risk that comes from those companies' debt. What you're left with is the pure business risk for that industry. Then they take that pure risk number and re-lever it using the private company's own target debt levels. It's like building a custom synthetic beta from scratch that perfectly reflects the private firm's total risk. It's pretty cool. So at the end of the day, what's the big takeaway here? WACC is so much more than just a formula and a spreadsheet. It is the price a company pays to fund its future. It's the number that captures the risk investors are taking and the return they demand for taking it. And it leaves every single business leader with one final critical question. Is the future that you're building actually worth the cost?